In this video, we are going to discuss about current ratio, or I must say it is the working capital ratio. Now, what is working capital? It is the difference of current assets minus current liabilities. Now, in the introductory video, we discussed that current ratio is one of the type of liquidity ratio, which tells us the short-term financial position of a company. Now, in this current ratio, the outsiders or trade payables are interested, the banks are interested, the employers are interested. So why they are all interested in knowing the current ratio? Because it tells them the company's ability to meet the current obligations. Now, why it is known as current, or what is the difference between the current and non-current? So it is the whole concept of the current depends on the time period, the assets and liabilities, the time they take to get converted into cash. If I talk about assets, then how much time will they require to be get converted into cash? Or if I talk about the liabilities, then how much time does it require to make the payment? So that's all about the time. Now let's compare two assets. One is the inventory and other is the plant and machinery. So inventory, if I talk about, gets converted into cash within 1 year, or even less than that, within 365 days. But if I talk about plant and machinery, then it takes more than 1 year, 2 years, 3 years, or 5 years. So the time period, if it is less than 1 for an asset to get converted into cash or a liability to be settled within 1 year, then it is known as current. Now moving further, how to calculate the current ratio? So it is current assets by current liabilities. Current assets by current liabilities. Now the ideal ratio is 2:1. So what it means that 2 times the assets of the liabilities. That is, I must have 2 rupees or $2 to make $1 payment of the liability. Now moving further, what actually current assets include? So they includes the current investments, that is 12-month investment, net trade receivable, that is debtors minus bad debt provision. They include cash and cash equivalents, bank balance, commercial paper or treasury bills that gets converted into 12 months, or short-term investment, short-term loans and advances. It may include inventory. It includes inventory also. It includes prepaid expense. It includes advance tax, accrued income. That is those all assets appearing in the balance sheet of the company, which takes a time period to get converted into cash, which is less than 12 months. So they are known as current assets. Now what is current liabilities? So current liabilities includes short-term borrowings, which also include bank overdraft. It all includes trade payable, that is the creditors, short-term provisions, that may be income tax provision or proposed dividend or any other provision, or other outstanding expenses or unpaid dividend. Now all those liabilities appearing in the balance sheet which the company needs to pay, and this payment has to be made in less than 12 months. So the formula is current assets by current liabilities, and it tells the company's ability to meet short-term liabilities on time. Now let's take example of top retail companies. Now first is the Walmart. Walmart has a current ratio of 0.89, whereas Kroger, another retail company, has a current ratio of 0.77. Costco has a ratio of 1.22, and Target has a ratio of 1.02, and Amazon, which is now in top 10 retailers has a ratio of 0.89. Now, if I was given a choice to buy a share depending only on the current ratio, though my preference will be that company which has a ratio near to the ideal ratio. Now, ideal ratio is 2:1, but that ideal ratio is generally not preferred. It is somewhat near to 1.33 to 1.5. So in this case, my first preference will be Costco and the second will be the Target, because I must have the asset, the current assets to make the obligations, that is the current obligations. Now if I talk about top Indian retailers, so this side, that is the trend of Tata, so they have a current ratio of 1.83. Shoppers Stop has a current ratio of 0.77 and the Future Retail has a current ratio of 1.02. V-Mart has a current ratio of 1.33 and Cantabile Retail has a current ratio of 0.93. So again, if a choice is given between these companies, so the first preference on the safer side will be towards the West side, and the second will be the V-Mart, and the third will be the Future Retail. So that was all about current ratio. Thank you.